All right, we will be talking about Bollinger Bands today, and basically for today's topic I will be showing you how institutions use Bollinger Band. I'll show you how institutions use Bollinger Band. Okay, it's not just the normal way that we all use Bollinger Band. Institution actually trades with Bollinger Band, so I'm going to show you how they do that. Okay, but before we start, all you need to do is like, subscribe, share and comment. Okay, I'm going to give you a free PDF on the checklist at the end of the video. So all you need to do is like, subscribe and comment, and you'll get the free PDF. Alright, so let's dive in. Most traders use Bollinger Band the wrong way. They buy at the lower band, sell at the upper band and get stop out. Institutions do not trade that like that, and in this video I will show you their sniper twist. So the first thing you need to do is you come to your indicator and type BB. You choose this first one, the Bollinger Band. If you choose this first one, I'm going to use two indicators on this. This is the settings. This is settings, nothing changed, everything remains the same. And then the only thing I'll change is these colors, because I just want to deal with only one color. Okay, so I'll change everything to black, remove the background and remove the label and the value. So my Bollinger Band is coming out neat and clean. The next indicator I'm going to use is called the TDI. TDI, Traders Dynamic Index plus RSI Divergence. That's what I'm going to use. So I add it up. And then the next thing I'll do is change my settings. I'll go to input first. Everything remains the same except this fast MA on RSI. So I'll change this to 2 and I'll change the slow one to 7. That's the only thing I'm changing. Every other thing remains the same. Then I'll highlight this: plot hidden bullish engulfing, plot hidden bearish engulfing. I already understand that you guys understand divergent. Then I'll remove all this. I don't need them. Okay, so I'll remove all that. I'll leave only these three: MBL, RSI and TSL. Remove the shapes, leave all this on, and then remove the background plot. I don't need the background color. Remove the labels and the value. So this is what I have on my chart, these two. This is what I have now on my chart. Now most traders, what they do is they come, once price gets to the upper part of the Bollinger Band, they want to sell. They just want to sell. That's what most traders do. Once they see price at the upper band of the Bollinger Band, they just want to sell. Most times that's not how it works. Most times, like here, see, once price got to this place, some people will want to sell just because price has gotten to the Bollinger Band. But as you can see, price broke out of it. Price broke out of it, which actually showed that that was not the right way to trade it. You can see price went back and broke out of it. That wasn't the right way to trade it. Price went back, broke out of it using this particular candle. Price broke out of it. Okay, so that wasn't the right way to trade it. So institutions do not trade like that. They use three things. They look for three confluence before they will take their trade. They need just three confluence. Okay, so I've shown you how. And also when price comes to the lower band, people tend to buy, you know, just because they have seen price at the lower one. Imagine seeing price at this lower band here, and then you just want to buy here. You just want to buy here. Just because you saw price at the lower band, you want to buy here. See what happened? Price came down more. Price came down even more. See what happened here? Price came down even more. So you don't just buy just because, you do not buy just because price is at the lower band. Neither do you sell just because price is at the upper band. No. There are ways to go about it for confirmation and for entries. Okay. So most times this will be a retail trap versus the institution entry. Okay. Now Bollinger Bands have three parts: upper band, lower band, and the middle band. Traders use them to spot overbought or oversold zones. But here is the mistake: price doesn't always reverse at the band. Okay, just like I've shown you, price does not always reflect at the band. This is the lower band, this is the upper band, and this is the middle band. Okay, price does not always reject at the upper band. Imagine here, price getting here and then you want to sell. No, it doesn't work that way. It can kick you out. So that's how retail traders look at it, but that's not how it works. So I'm going to show you in this video how the institutions buy and sell. Institutions do not just buy or sell at the band. They wait for 3 sniper confirmation before they take their trade. They wait for 3 sniper confirmation before they take their trade. And I'm going to list the confirmations that they look out for. Number one is the divergence. They look out for divergence. Number 2, they look out for liquidity sweep. And then number 3, they look out for an engulfing candle. These are the 3 things you need to see before you confirm your direction and then you take your trade. Okay, first of all, what is a divergent? That's the reason why I brought in this TDI RSI divergent, because it shows me all the divergence. What is a divergent? When price makes a higher high and RSI makes a lower high. Okay, that's bearish divergence. When price makes a higher high, you can see from there, from here, price made a higher high. This was a high and this was a higher high. And then while the RSI made a lower high, okay, from here to here, this is a divergence. So once you see this divergence, this is one of the things they look out for before they consider taking a trade. Okay, this is for a sell, a bearish trend. For a buy, what they look out for is, for a bullish buy, you look out for when price makes a lower low, when price makes a lower low and the RSI makes a higher low. I'm looking for it to show you guys. I'm looking for a perfect one. All the ones showing here are just hidden. Because the hidden means price is going to continue going up. But the hidden is for continuation, while the proper divergent is for reversal. So I'm looking for a better one. or maybe we'll have it on another time frame. Let me check another time frame. Still series of hidden bullish. Okay, this is a bullish one now, which is not hidden. Okay, so here price made a lower low. This is a lower and this is a new low, or perhaps let me take it. Price made a lower low. Price made a lower low here. This is a new low. Price made a lower low and then made a lower high here. So this is a divergence. So this is a bullish divergence, which is what the institutions are looking out for. That's one of the things they look out for. Alright, so the next one I'm going to explain is the liquidity sweep. How do you understand liquidity sweep? It's just basically when the price sweeps the stops above or below the band before reversing. Basically when the price sweeps the top band, it sweeps the top above the band and also below the band before reversing. Now this method I'm actually showing you guys is actually for reversal trades. I'm not teaching you continuation trade. This is only for reversal trade. Okay, so how do you identify your liquidity? The first thing is you look for the previous high on your left. You look left and look for the previous high on your left and mark it. For instance, let me zoom this out. For instance, this was your resistance here and this was your liquidity. Liquidity is basically there are different types of liquidity. I'm not going to go into that in this video, but I'm only going to tell you about the ones that you can identify using the Bollinger Band. Okay, so the highs, the previous highs and the previous lows is what we are going to use here based on this. Now this is a liquidity at this place. This was a liquidity. This particular high here, this was the high. This was higher than this. This was also a liquidity. That was a high. So you mark, the first thing you do is to mark that place and keep. Once you've marked it, you wait for price to come back into that place. As you can see, price came back into the place. Price came back into here. What did you notice? Now, this is the upper band of the Bollinger Band. And you've marked your liquidity. Price broke this first one and came for the second one. Now looking at the second one, what are you seeing? You're seeing that price took the liquidity out and then came back and closed below the previous high. Below the high of that previous high, it closed below it. So that's a liquidity sweep. That's a clean liquidity sweep. So the next thing you are going to look out for is for price to come back inside the Bollinger Band. Once you notice that price has come back inside the Bollinger Band, you just keep waiting. That's the number one checklist that you're going to look out for. Liquidity has been taken, and that liquidity is outside the Bollinger Band. Okay, so like I said, the liquidity here are found outside the Bollinger Band, either the upper band or the lower band. Okay, that's what you are going to look out for. Like here, let's look for the previous liquidity around here as well. In this particular case, we had a liquidity here, this particular one. That was the low. Even though that was not the lowest low, this was the low. This is also a liquidity, but you are going to mark based on the swings. That's also a liquidity. This was a swing low, so this is a liquidity. So what you need to do is you mark these places and keep. You wait for price to come back and retest it. Now when price comes and rejects it, it's going to be a rejection. So what you are looking out for is that price will come to the come outside the band. This is the lower band, so price needs to come outside that band. So when price closes outside the band and then push back into the band and then start ranging or trading around the band and then suddenly move up and close above that liquidity, that's the liquidity sweep using Bollinger Band. That's how market makers identify their own Bollinger Band. That's checklist number 2. Now the third one is the engulfing candle. The third one is the engulfing candle. What are you looking for? Once you see the liquidity sweep, what will you look for next? The next thing you're going to look for is an engulfing candle. So you're not just going to take your trade just because you saw a liquidity sweep. No. What you're going to look out for is an engulfing candle. So you're going to wait for the engulfing candle to print on that time frame. So what's an engulfing? You're going to wait for a bearish and a bullish engulfing candle. Now on this 15-minute time frame, we all know, we should know how engulfing candle works. I don't need to start explaining that. This is an example of a bullish engulfing candle. This is an example of a bullish engulfing candle. First of all, the red candle, the green candle must engulf the red candle. The green candle must engulf the red candle. This is a bullish engulfing candle. This is an example of a bullish engulfing candle. This is for a buy. This is what you'll be looking out for if you want to buy. This is for a buy. And then for a sell, the green candle, the red candle will engulf the green candle. This is what you are looking out for. That one of the candle will swallow the other one. So this is how they look. I'm going to actually still show you on the chart. So you'll be looking out for an engulfing, bullish engulfing or bearish engulfing. You can go and do more research on what is a bullish engulfing candlestick pattern or a bearish engulfing candlestick pattern. That's what you need to learn. I don't need to start doing this on this video, but I've also illustrated how it looks like. You're going to see two candles, one will engulf the other. For a bullish candle, the green color will engulf the red one. For a bearish candle, the red one will engulf the green one. So after the liquidity sweep has happened, what are you looking out for? You are looking out for an engulfing candle. See here, this was a green one. This red one, this has not engulfed. All you really need is an engulf. It must engulf everything, even including the low. It must engulf in everything. This is the one that has engulfed. These two candles are the ones that have engulfed each other. That's the one. Those are the two candles that have engulfed each other. Or that have engulfed. The red candle has engulfed this green candle. That's what I will consider my own as engulf. I will consider that as an engulf. So I will see that as an engulf. So what will you do? You mark the high of this engulf. You mark the high of it and keep, because that's where you are going to take your entry when price comes back there. Then the third thing you're going to look out for is the divergence. You're going to wait for the divergence to happen. Now you've seen your liquidity sweep, you've seen your engulf, even though this has not really engulfed in a way, but this third candle has engulfed it, has engulfed these two red candle, this one and this one has engulfed the green one. So for me, I'll consider that as an engulfing. So you mark the high of that engulf and wait for price to come back and retest that place. That's where you will consider taking your entry. But before you take that entry, there is one more thing that you need to confirm, and that one thing is the divergence. Okay, that one more thing is the divergence. So looking at it here, you are going to look for a bearish divergence, which means price needs to print a divergence. This is a higher high. Price here has printed a higher high, while here on the RSI printed a lower high. So let me show you here, from here to here, this is a higher high. Then from that same place, which is here, to here, this is a lower high. So even though the indicator did not show you, but you can see clearly from the RSI that this is a divergent. And after seeing that divergent, that is your confirmation that the price is going to change direction. So that's when you now take your entry. Like I said, you mark that place, you take your entry around here, and then your stop loss should be above the previous high, probably 30 pips above your previous high. You take your entry around here and then target the lower band. You can actually depend on the swing you want to take, but you target the lower band. The lower band should be your first TP. That should be your first target. You target, this is gold. If you are taking the trade from here, let's say down to the lower band, that's almost like 90 pips for you on it. So that will be your first target before considering every other thing. That will be your first target. So that's how institutions trade Bollinger Band. That's how they trade Bollinger Band. That's just how they trade Bollinger Band. So you need these three things. You need to look out for these three things. One, the liquidity sweep. Two, the engulfing. And the third one, the divergence. You need to see those three things. So when you see those three things, it is a high probability trade. That trade is going to play. Let's put it together. Watch this example. Price hits the upper band, sweeps the liquidity, shows divergence, and confirm with a bearish engulfing candle. This is a high probability short entry. As I just said, price hits the upper band. First thing first, price will hit the upper band, sweep the liquidity, and after that, what happened? It shows there was a divergence and also there was a bearish engulfing candle. So with that bearish engulfing candle, this is a high probability trade. Okay, this is a high probability trade. So those are the three things you need. You need to have a liquidity sweep, a divergence, and an engulfing. Okay, those are the three things that you need. This is how the institutions trade. This is what the institution look out for before they consider taking a reversal trade. This video is only for reversal trade. Okay, so you see the difference. Instead of just guessing every band rejection, we wait for those confluence. That's how institutions filter bad trades and only strike on high probability trade. Okay, instead of just, oh, price got here, you just want to buy, no, or you just want to sell, no, you wait for all those three things before you will take your trade. Okay, so that's how it works. So this is a sniper trading institutional Bollinger Band strategy. If you found this useful, hit subscribe and download your free checklist PDF in the description. And don't forget, I drop new sniper setup every week. Okay, I drop new sniper setup every week. So subscribe and follow, and click the like button so that you will be able to get notifications on every new video that I make. Thank you and have a nice day.